Hmm. Ladies and gentlemen, esteemed members of the Federal Reserve, members of the press, and honorable guests, GM, I stand before you today in this most august chamber as Tom Powell, your faithful servant, bearing the torch passed down by my namesake, Jerome Powell, and others, in an unerringly embracing the sacred duty of guiding our country's monetary policy. The monetary landscape we find ourselves traversing today is one that would befuddle even the most sagacious of Greek philosophers. We stand in the precipice of a swirling confluence of factors, each presenting its own paradox. Indeed, like Odysseus navigating the narrow strait between Silica and Charybdis, we at the Fed face a Herculean task of balancing price stability, growth stability, and financial stability. Tasks that seem so impossibly intertwined that one could imagine us caught in some economic Gordian knot. In short, my friends, we find ourselves caught in an economic catch-22. Take, for instance, our current inflation scenario. With wage inflation sitting robustly at 5%, we find ourselves in a peculiar position. This rate, while indicative of a strong labor market and a signal that we, the working populace, is receiving its fair economic growth, still overshoots our 2% inflation target, creating a quandary. At the same time, our labor market is tighter than a banjo string. Unemployment is at an inviolable low, and yet the average age of our populace continues to climb. Migration is under restraint, and we see a palpable decrease in labor force participation rates. Then there is also the Great Resignation, still ongoing and contributing to labor market tensions. Now, to add another layer to the complexity of this situation, we see the stirring embers of labor strife. In such tumultuous times, it's natural to seek stability, an anchor in the storm, if you will. Some may argue that such an anchor lies in commodity prices, but recent corrections, born out of recession fears, have reminded us that even this seeming stalwart can waver. Yet it is here that I would like to draw your attention to a theory I subscribe to, that we are in the midst of a commodities super cycle. I posit that this super cycle is a direct reaction to underinvestment in green energy, oil, metals, green metals, and economic response to the lack of attention paid to these crucial sectors. Even as we face corrections, I remain steadfast in my belief that these sectors hold immense potential and could serve as important cogs in our economic machine. So here we are, in an era of interest rate hikes and mixed macroeconomic data, in a situation where we're damned if we do and damned if we don't. Despite this, we have a duty to make decisions, to tread lightly on the tightrope, and to navigate our economy through these murky waters. Rest assured, the Fed is fully committed to this cause, to guiding our economy with wisdom, fortitude, and the data. In this era of uncertainty, we don't have the luxury of perfection. What we do have is the power of decision, the courage of conviction, and the wisdom of experience. As I stand here today, I assure you that we will face these challenges head on. We will strive for balance, for stability, and for prosperity. As your humble servant, Tom Powell, I pledge to navigate this labyrinth of complexity with the same determination, grit, and unwavering commitment that has characterized the Federal Reserve since its inception. So let's roll up our sleeves and face the music. Let's untangle this knot. After all, isn't that what we do best? Thank you. I am Tom Powell. Tom Powell, the man himself, joining us live again. I don't know how we get him. Fam. It's probably because of all the likes and subscribes and engagement you guys are doing out there. Welcome back to another FOMC meeting, and today is going to be spicy. We have predicted, we have watched, we have speculated on everything going on, and it seems that the Fed is determined to continue raising interest rate hikes. raising the interest rate, terminal rate, whatever, putting pressure on banks, especially small regional banks. We have not seen any new banks collapse since the last FOMC. However, what happens today is likely to have a great weight on going forward. The market does seem to be predicting a 96.6, I just refreshed it, actually now down 95.5% chance of no interest rate hike. Earlier in the month, we saw a 25 BPS actually be favored over 50%, and now it seems that we've swung back to no hike. There are some definite possibilities here. There's a poll going in the chat. Please vote. Let us know your opinion. It also counts as engagement. Engage with the chat. If you're here, put something into the chat. Let us know you're here. Smash the like button, subscribe, share. If you have the reaction button on your mobile device or on your computer, send some hearts, send some hundreds, whatever. Basically, there are a few outcomes. I'm going to tell you them, and then I'm going to tell you what I think is going to happen. On the poll, we have no interest rate hike. Pivot is here. Then we have no hike, but more hikes to come in 23. And then we have 25 BPS and a larger than 25 BPS. So in order of what I think is going to happen, basically from the bottom up, I think, no, actually with one caveat. So I think we're not going to have a hike today, but I think we're going to have more hikes into 23. Why? It just seems to be what the Fed is looking at. The data that they always have to look at is just not where they want it to be. As Tom Powell touched on, we are in a complex situation that seems to be a catch-22. Doesn't really seem to be an apparent answer or solution to the situation we're in. We have talked about these live. We are the OG live FOMC coverage channel. We've been doing this for years before anyone was paying attention. And what we try to do here for anyone new joining us is we try to take what is a very boring speech, a very boring event, and we try to make it a little fun. So with your help, guys, hype the chat up. Have some fun, get some hype. We also are going to watch some charts. We're going to look at the dollar, stocks, and Bitcoin, and we're going to watch them in real time react to Powell, to the interest rate decision, and it's always a good time. So welcome back, everybody. It's good to be here. It rained again, by the way. Pretty interesting. 2 rains. Hasn't rained in over a month, and now it's raining, and I like it. I invited a bunch of other creators to stop by during... Whoa. Why is that happening? During this stream, hopefully people pop in. Hopefully I catch them. Hopefully I catch them and say what's up. So yesterday we did have PPI. This is what's interesting. Coming in under forecast. This is actually a good thing. This does show inflation could be slowing. It does not suggest inflation is done. It doesn't suggest we're in stagflation. Just that it is slowing. What's interesting is I've been reading articles that we are forecasting that into the end of the year we're going to see historic changes here on our PPI, CPI data. That could be the data that the feds are looking for, but it's not there yet for all the reasons Tom Powell went over. What's next week? Next week is surprisingly uneventful. Services PMI. That's pretty much it. We got building permits, existing home sales. Weird. We don't typically see a week with such little spicy numbers coming out. Let's turn on some tunes so my headphones don't turn off. Awesome. Markets, stocks look pretty flat. Dollar down a little bit and VIX down as well. Not anything really of concern. Let's pop onto our main chart here. So let's start out the stream. We have pulled up here, as I said, we have dollar in the top right, Bitcoin bottom right, and the S&P is behind me. We're going to have the Fed live stream up in the top left once we start. I'll just put that up there. First things first, guys, I always start these with this. These are extremely volatile events. Trading is very dangerous today. I don't recommend, especially with leverage, looking to make a play. However, we will be watching them. We will be breaking them down minute by minute, candle by candle. Typically, what we see, at least for Bitcoin, and maybe this does apply for all assets, is into the decision, into the interest rate hike, which will be in 47 minutes. We will get that, and we will all Google that live and try to get that number first, breaking. Typically, we see Bitcoin or the dollar, either or stocks, trending either up or down. This has been pretty consistent. As I said, I wouldn't trade this, but typically we see it trending up or down. Once that rate decision is in, we typically see it reverse, whether it's trending up or down. Reverse into Powell's speech, and then we commonly see it reverse again and continue. So what basically this says is these are high volatility events that are likely to stop out longs and shorts. This is not a good day to trade, in my opinion. It's a really good day to get wrecked if that's what you want. I think we've had enough wrecked for the year already, so maybe we'll skip that. We have marked on our chart when each of these things come out, and we're going to be watching them 5 minute by 5 minute. Tom Powell already spoke. 45 minutes to the interest rate decision. I am going to pull up, what is this, market? Crap. Someone sent me that. Someone sent me the link. It was like market. No, it's Forex Factory. That's what it is. Let's pull up Forex Factory. Someone sent me this in the last live stream and said this is where I can get in the minute updated numbers. And so let's see, Wednesday, June 14th. Yep, there's core PPI and PPI, FOMC statement, federal interest rate. Here it is. So hopefully at 2 p.m. this will update, but we will still do our ceremonial, traditional Googling because it's a fun event together. So I'll have this pulled up. That's 2 p.m. Make sure everything's good with the stream. Hopefully I wasn't muted or something that whole time. Doesn't seem like I was. Cool. Let's look at the dollar here briefly. We have this on the weekly time frame, and the dollar is the logical thing to be impacted by these interest rate hikes. In an environment where I guess this was actually increasing rates, wasn't it? All of 22. Rates were increasing. We saw a flight to the dollar. This pushed up bond yields, bond prices. And then I guess come 23 with the, I won't say it wasn't a reversal, but these interest rate hikes started to get smaller. We were as high as 75 BPS and discussing 100 BPS. And into this year, I believe they've been all 25s. Man, I've been doing this for so long that it's hard to keep track. But as these kind of softened, the dollar showing some weakness here, and we've been following this very closely. We predicted in our previous live streams that at the end of May, we would see a lower high up to about 104, trade to 104.7. Lower high does look to be in on this weekly chart. We have 2 weeks working on our third week of dollar weakness with lower lows. The dollar does look to be returning to this 101.7 zone. And what does that mean? When the dollar is weak, just like everything that is paired, whether it be Bitcoin to the dollar or stocks to the dollar or Nvidia to the dollar. By the way, Nvidia hit 420 today. Blaze it. Best number. Well done, Nvidia. Because they are paired with the dollar. When the dollar is weak, those assets logically rise on the weakness of the other side of the pair. When the dollar is rising, like it did all through 22, it is logical to find weakness in the other side of the pair, which is stocks, Bitcoin, etc. So what we're looking at here, as the dollar looks to return to 101, is basically another retest of this support. Now, each time support is tested, it weakens and suggests that it will be broken. The more times you test resistance or support, the more confident you can become in that being broken. So we're returning again down to 101 after 1, 2, 3 lower highs. This is creating a flat bottom. With lower highs, we look for a dump. Depending on what happens today, if we do see a spicy move out of the Fed, maybe a 50 interest rate BPS hike or 25, we may see the dollar regain some strength. If it comes out with the no interest rate hike today, logically, the markets have been pricing that in as they've been pretty confident for a few weeks now in no rate hike today. We may see the dollar reverse and equities, stocks, assets, commodities take a little dump. So the dollar is following what we've been looking for. It is reacting as if it's getting no interest rate hike today. Chart's looking decent. I will say the dollar is one of the craziest charts I've ever watched as an analyst. It always seems to pull some kind of tricky move on me. So I wouldn't get too comfortable in this plain analysis, but I figured do the easy one, do the easy analysis for everybody. And get it out there. Quickly into Bitcoin. On our last live stream, we were looking for a rally to the 200 weekly. Exactly as predicted. Bitcoin reached up to the 200 weekly and almost to the penny here at 26,437. We were looking for a rejection. So that TA was perfect. That was perfect. Back here, the call was made. It took 19 hours to reach the 200. and 22 hours to get back to 25.8. So you may see that price is not actually following these lines anymore. As we get farther out, predictions, speculations get less confident, and that's what we're seeing here for sure. I was looking for a move under 25.8 to reject price to move down to our range low. It does not seem that Bitcoin had that in mind. Perhaps this is the market pricing in no interest rate hike today. That would be pretty logical. Pretty logical here. And it seems to be holding 25.8. So the TA was on and now getting a little farther from reality here as it trades sideways. I think this is a show of strength, especially off of the let's fire Gary Gensler, SEC, Binance, Coinbase suits being filed. Bitcoin, I won't say crypto, but Bitcoin is showing extreme resilience in spite of what is great odds. Now, I think it is a bluff for the most part. This seems kind of unhinged as a move from the SEC. There's no way they can have the resources to take on so many battles. Needless to say, to take on two of the giants in the crypto space, Coinbase and Binance, it seems weird. I have a weird feeling that Gary Gensler will not be the SEC chairman for long. That is my hunch. So as Bitcoin holding 25.8 here, this is looking pretty good. It is deviating from what I expected. A mix up today, as we said, 25.50 BPS. We may see it follow this trend down. And if it doesn't, the next logical move will be back to the 200. Testing the 200 again, hopefully this time breaking through it to the upside and seeing continued upside. But that is definitely getting ahead of ourselves here. Dominance remains high on Bitcoin. So as we've said, altcoin pain is on the books. Let's make this a little bigger. Do not expect any reprieve in the short term on alts for the moment. Now, this doesn't mean alts necessarily have to go down in dollar value. If dominance does trade back below 48.9, maybe I'll waver on that. But it does suggest that they will lose value versus Bitcoin. So they may stay sideways on dollar value. If Bitcoin makes a move up, maybe they'll make a move up on USD as well. But for the most part, altcoins for me are a no-touch, at least at this moment. Now, we do have some things that seem to be an exception for now. I would be wary, assuming that that will continue to be true indefinitely. But we also see, in addition to Bitcoin, Ethereum, and even something like XRP, holding really well at these levels while other things dump. Basically, retail investors, whatever, seeking a safer asset in the turbulent times where the word security is being thrown around, where accusations are flying wild, and no one really knows what's going to happen. Uncertainty in markets commonly leads to flight to safety assets, and in crypto, that's apparent that right now it is Bitcoin, Ethereum, their XRP. There is likely others. I don't mean this to be a whole list. Pay attention to your charts. Watch what's going on. Really quick into stocks. This is the hunch, or this is where the hunch that no interest rate decision or no interest rate hike is coming today. S&P 500 broke through 4,300. This was August 22's high. Now, this was pretty significant and suggesting that no rate hike was coming today, as that was a major resistance. We don't see another one until we go back to March 22's high at 4,600. This is big for stocks. That's 6% upside. The reason this is big, not monthly, the reason this is big is the S&P 500 is now up 14% for the year after a very bearish 2022. It does look, in my opinion, to move back to like 4,700, test last year's open for liquidity. I don't know what will happen then, but I still think we're on some kind of, I don't think this cycle is over. I feel as if we haven't seen the blow off top that is to come, but that's my speculation, my opinion. I'm wrong all the time, guys. Don't blindly follow anything I say. Just take whatever value you can get here. Put it in your value bank. We have a bunch of subscribers. Hell yeah. Hell yeah. Keep it up, fam. Keep smashing the like, sharing the stream, subscribing. What is up? Gaming.net. Tom Chase. Great name. Handsome name. Bassa Trader. Alan Koch. Jared the Coffee Guy. Thank God it's not Jared from Subway. Gautam Rajak, Nick Buchanan, Silver Rum, all subscribe today. Keep it up. I'm going to be reading the chat here very shortly. I just want to get through some of the 101. We have 1,800 viewers. We got a bunch of subscribers. Hell yeah, fam. Let's go double chill. Who else is here? It's autopilot Mohammed Uzar Long Mountain. What's up, man? You know what's funny, Long Mountain? I feel like I ordered these shades from a company named Long Mountain or something like that. The most recently. Bruno Toriello, DJ Johnny, Rasknor Keezy, Mr. Techno Goody. What's up, brah? Draka. What's up, brah? What's up, bras? And braettes. Nah, bra is gender neutral term. Everybody's a bra. What's up, bras? Brah. What's up, Queen, Alex, Randy, YouTube channel, Netstar, Beans and Rice, Meme Takes, Muhammad Rafiq, Jim Kennedy, Bruno, again, from Argentina. Shout out to Argentina. Welcome to all of the global fam we have out there. We are worldwide, baby. Like Pitbull. Like Step Brothers worldwide. The White Buddha. Buddha is the bish. All right, cool. Gary can buy you a flat in another country. Don't like spending habits. That's right. Gary seems to be protecting the U.S. investors from the dangers of gains. That really feels like what he's doing. And I'll give it to him. If we have nothing, if we have no assets, if we have no value or wealth, we are protected because we have nothing to lose. Goddamn Gary. Hashtag fire Gary Gensler. Love your new Apple goggles. Do I have Apple goggles? I'd like them. They look all right. I just don't want to spend $3,500 on them. I spent $2,200 on that sweet solar panel setup generator. Okay, this is bugging out. It's bugging out. Love from India. Love to India. Love to every person around here. We are a global fam, as I said. We are all one via crypto markets, etc. And we're all on this ride together. So shout out to you. Shout out to everyone. The most dangerous man is one with nothing to lose. I like that. Sounds like the start of an action movie. Let's take a peek quick at Tesla. We looked at this last week. It broke through, 217, went on a ripper. I did say I think it's very dangerous to long Tesla on the last stream. I still stand by that, but that is looking less and less like reality here as it does continue to rip up. This was like right near, it was like 230 last time I said this. Tesla does look like it's taking a trip to the 300ville in some kind of descending, broadening wedge. A lot of stocks, well, we won't say a lot, a very few amount of stocks look like this, including Apple, Tesla, whatever, I'm sure you can name more. Really just these strong stocks at the moment have this broadening wedge breakout going on. Apple, of course, stealing the eye as it hit a new all-time high in this month. I'll pull up Apple quick. Wow. Wow. Go Apple. Go Apple. Let's get rid of these. Hasn't quite broken through last week's high. I was looking for just this pattern to play out. This descending broadening wedge typically is characterized by a pullback to the descending high trend. Oh shit, it's storming again. Whoa. All right, what I need from the fam, please collectively pray that my internet and power do not go out. I just heard a crazy loud crack of lightning. I don't know if you guys heard it. Holy shit. That would be eventful. If my power does go out, I don't know what to say. If the internet goes out, that would suck. Let's hope it doesn't. That's why I need you all to pray. So Apple, just based on this pattern, I would look for a pullback to this high trend. Now, this week's candle is showing strength, and maybe we don't get the back test. They are never guaranteed. However, just this classic pattern would suggest that, so that's what I was looking for. That would likely be a return to like 170, 175, something like that. Whew, that was a big crack of lightning. Big old crack of lightning. Whew, it almost scared me a little bit. Let me see here. Let me see. Who else is in the chat? All right, collecting my thoughts. Let's take a peek at our Chairman pre-interest rate price action here. I just need to copy this stream's link. Make sure you're sharing this stream to everyone. Let them know. Let them know. Also, I forgot, check out our sponsors video. Link in the video description below. FEMX and Fairdesk. Sign up using my link for big bonuses and as well for supporting the stream. Costs you nothing. In all transparency, a small percent of the fees you pay go to me instead of the exchange. They are our sponsor. It makes me look good. I trust both these platforms as much as I can trust a centralized exchange, which is limited. I've been working with them for a long time. So What are we seeing into the hike? We're seeing the dollar trend up, I want to say. It was trending down. It looks like until Tom Powell spoke, Tom Powell kicking off dollar strength. Bitcoin trending down, at least at the moment. Into Chair Powell, interest rate hike, etc. Same with stocks. So, again, this is highly speculative. We have seen a pattern. Oh, I gotta close these windows or it's gonna get wet in here. Wow. For those of you who haven't been around, welcome back, but it hasn't rained here. All of April it didn't rain. It hadn't rained for like 40 days. It rained on the last stream for the first time in like 40 days. My garden is dead. And now it seems to be raining again. I welcome it back. Holy hell. I might have to close these windows at some point. So based on what we've seen in the previous FOMCs, if the dollar is trending up by the time the rate hike comes in, it is likely then to reverse. To retrace some of those gains. We see it happen again when Chair Powell speaks. Now, this isn't locked in yet. We have to see really closer to the time of the interest rate decision which direction we're trending. But that may suggest some kind of bounce on the dollar, which doesn't really make sense. If no interest rate comes in today, a bounce on the dollar isn't the logical outcome of that. However, the dollar has taken kind of a dippy over the last 2-3 weeks, and a retracement maybe back to 103.7 for a lower high would not be crazy actually to expect. Let's zoom these back in. Wow, that is some rain. I don't know if you guys can hear it. My mic will take out a lot of these sounds. That is loud. Oh, please don't go out. Internet, please don't go out. What's up, Bucko 504, Jamie Crine subscribing, Mohammed Yuzar, Gorek Meeden, also joining our fam. Great to have everyone. Great to have everyone. Did I see someone? Mitch Ray. What is up, my man, Mitch Ray? My favorite dude to hang out with in Miami. If you guys aren't subscribed to Mitch Ray, he does a lot more, I want to say a lot more stock content than we do, but he does crypto. Great TA guy, one of my inspirations. Highly recommend you subscribe to him. One of my inspirations for streaming. Shout out to Mitch. Wanted to come say hi. All right. Sasha MH, new subscriber. What up, Sasha? How you doing? How you guys feeling today? Have we seen optical art? Has Steve made his appearance yet? He will. He will. We got 1,000 votes in the poll. No hike, but more hikes in 2023. Wow. That's a rough brain fart. 37%. Pivot is here, 35%, and still 27% of us holding out for an interest rate hike. Interesting. There's some spicy odds on this. Spicy, spicy odds. Ready for the VIX to pop. There he is. There's Steve. There he is. In Steve fashion. Bitcoin is a Ponzi. Live the dollar. If you want your bearish takes and analysis, definitely check out Optical Art. Steve is an OG in the space. He's been making content forever. He is the yin to my yang, as I like to say. Check him out. He's a good balance to my content. We're overly bullish a lot, and I'll say, sorry, Steve, at times overly bearish, Steve, so we balance each other out well. Really good yin and yang, synergistic content. Dollar is rising here. Maybe Steve's onto something on the 5-minute. Roll on, Powell. Let's go. Beans and bullets. What's up, Jacob? Sprouts Kane rain down on me. I wish I could play it. I wish I could play so much music. YouTube does not let you. Bitcoin dominance is going to dump out in Buzzard. I hope so. I'm down. I love Bitcoin. I'm a Bitcoiner, but I would love to see dominance take a dive. Ooh, don't mix yings with yangs. You could catch something. You're a goof. You're an effing goof. Let's see. Make sure you've joined the Discord. Make sure if you're out there and you haven't subscribed, subscribe now. You want to be part of this family. We are racing Bitcoin to 100K, and we are winning. And with your help, we'll continue to win. We broke through 80K last week. And with your help, we'll get to 100K someday. That's right. Love Bitcoin, but would love Bitcoin dominance to crash. Absolutely. Because I think it would be indicative of further upside on Bitcoin. Because Bitcoin dominance going down, in my opinion, is bullish for crypto. Right now, looking a little bearish. Bitcoin is under. Maybe we should do... I did a little recap, but Bitcoin currently under the 200 weekly moving average. And I have been saying all year the same thing. If we are above the 200 weekly, I am bullish. If we are below the 200 weekly, I am bearish. So here we are back below the 200 weekly. Now, something I do want to note in our analysis lately. So this may please Steve. Please Steve. Please Steve. I hate these session break craps. Get them off here. I have been noting in my bearish scenario, and while we're under the 200 week, this is the scenario I'm looking to play out. Using all of the Fibonacci's, the 23.3 range looks very tasty. Could be as high as 24.3, but this would be my downside target for multiple reasons. This is the measured move target of our swing low to swing high in May. It is the golden retracement, the 618, from our swing low from March to our swing high in April. Now, those aligning is spicy enough for me, but there's more confluence here. We're now back below the 200 weekly, and the 200 daily, this green line below, the average price of the last 200 days is now at 23.7, so it's actually right in between 23.3 and 24.3. When we first found this, it was right at 23.3. Back in March, at 19.5, this was our swing low on Bitcoin. Tested that 200 daily before rallying to a new yearly high. That range, 24.3 to 23.3, the 200 daily right there, that was where we tested before moving higher. That is right there, likely to find support. Below the 200 daily, I'm going to get even more bearish. Below the 200 daily, a retest of at least March's low becomes more likely, if not yearly lows, but we're not there yet. This is the scenario I'm expecting to play out until we're back above the 200. Something of note I will say is the lower highs and lower lows pattern on Bitcoin, holding these lows, not dipping, not really crashing off of a break of the lows. We see some kind of descending parallel pattern, perhaps descending triangle, whatever you want to call it, and these are likely to resolve to the upside. But until the 200 weekly is broken, I'm not really looking for that. The good news is the 200 weekly is at 26.4. We're at 25.9. That's not even a 2% move to the upside, so you should have plenty of warning. Plenty of warning. Man, we still have 25 minutes before the interest rate is in. I should have waited to go live a little later, but maybe not. Maybe not. We have 500 likes. Did we passed 420? Give yourself a pat on the back, fam. 420. Blaze it. You all have your blazing license. Of course, it's optional. There are no requirements here. Everyone celebrates in their own way. What else should we look at while we have time? I might pull up the VIX. VIX was very spicing not long ago. Ew. Oh, this is kind of cool. I'll just use this as the VIX chart. There we go. I thought it was spicing. Maybe I was looking at the wrong VIX. Put this on the week. The VIX is essentially the volatility measurement for stocks in general. This is very general. When VIX is high, we see markets typically crashing. Typically crashing. As you can see, March of 2020, I think that was not the all-time high, but the second highest point since the 90s of the VIX, and that's on the 2020 March crash. Since then, markets relatively have trended up. Yeah, no, they have trended up. Very few have gone lower than March 2020. And we see volatility fell. Volatility falling typically lines up with markets trending up as they don't have as much movement. They really move up. Small retracements, movement up. I just smelled ramen. That's weird. Why did I just smell ramen? There's no one in this house. Unless Professor Beans is making ramen. She could be. Volatility is actually at a low. I thought it was trending up. Perhaps maybe it was one of these wicks I saw. But it is low. And it is looking to... No, it did break. June 21's low. Now, that is interesting in and itself. But we do see November 2017, our low broke. We did reach down to the lower echelon, the lower tier volatility. We actually followed this on Bitcoin, the Bitcoin's volatility, and we're very confidently able to say that perhaps the low was in, maybe not macro low, but a relative low in January or December of 22, before rising back up over time over, 3 years? Perhaps that's what we're seeing again. This would line up possibly with like that super cycle thought that Tom Powell brought in. If we see something like this happen, possibly in 2026, something like that, see another crash, another high, time will tell. Purely speculation. Dollar continues to trend up. Bitcoin does look to have kind of reversed or at least returned to the mean of when we started. which is deviating from stocks. You can't see stocks so well down here. Let's pull up just stocks. Deviating from stocks, the stocks haven't really reversed in the same manner. They've fallen. We're seeing them trending near their lows, and that is definitely in contrast with Bitcoin's movement back up. This isn't huge. It's not a crazy divergence, but it is looking a little different. In many, or I'd say in the majority of these streams, we see them trend together. That has been less true lately. I will say that. That has been less true lately. The correlation between stocks and crypto and Bitcoin does seem to be losing, or maybe lost correlation. Really, that's perspective. Much lower than it once was, very confidently. 100 BPS, says RSK Nor. All right, bring it. Bring it. Bring me chaos. Samran Charanga subscribed. What up? What up, man? Good to have you. Hitting the right buttons, yeah. Must come down, banks all in, and Fed is happy. So an interesting thing is the Fed, whether we like what they do or not, right, is not acting randomly. They're definitely calculated in the sense of they know what their actions do. They know what the consequences are of pausing hikes, raising rates, bringing rates down. They know the consequences. Whether or not we believe that is irrelevant. They know. They're calculated. They have been raising rates for a year and a half, roughly, knowing that this would collapse banks. They told banks that treasuries were safe, that they would, I don't know what the quote is, but that they would slowly bring rates up over time. In the last year and a half, completely knowingly, they have raised rates at the fastest pace, I believe, in history. They knew that this would collapse banks. Continuing to raise rates, they are fully knowing they will collapse more banks. That does not seem to be their concern. Does not seem to be their concern. Tom Powell said it best. I shouldn't even rehash. Damned if they do, damned if they don't. There's really no solution. They will slowly bring everyone to their knees. Does seem that way, doesn't it? We have a possibility of deflation. That can cause other issues. So a pause will give everything time to see inflation rise again or plummets. Well, they are speculating that inflation will come down the rest of the year at like unprecedented rates. I don't know if I believe that, but that's what they're looking for. Like with, some reason. I hope they have reasoning. I don't know if they do or don't. But that could be on the forecast. I don't know, man. Tell you what to do, Digital Orgy. I think that you should have a digital orgy. Giggity. What's up, Craigton C? Hikes are irrelevant at this point. Damage is done. I agree. They're now pulling out record levels of liquidity while the Treasury does the same thing. Tom Powell, man, talking about a super cycle in commodities. The man is the man for a reason. He knows things. Tom Powell, much wiser than me, much wiser than Jerome Powell, maybe even combined. F your puts, F your calls. J Powell has you by the balls. Bring facts. That's amazing. I love that. People expecting Republicans to help curb spending. I think that is a foolish expectation to expect either U.S. party in their current state to curb spending. I don't think that's a possibility. I don't think that's an option. Ball over. Can I get a chirp pow? Chirp pow, Chairman Powell. Chairman Powell, can we get chirp pow in chat? If you're here and you're ready for chirp pow, give us a little chirp pow, chirp pow. Chairman Powell. Cheer Pow, Gary Gensler, Mud Wrestle. All right. I mean, well, I don't want to watch that, but sure. I'll watch the highlight reel. Where's Gina? Hopefully Gina will join us. There is a Gina emoji now since last FOMC. Hopefully she'll join us. The beautiful, wonderful Gina, the love of my life, hopefully joining us after Jerome Powell's comments. Fingers crossed. She's the most intelligent, beautiful lady out there. And I don't let the fact that she's married to a woman stop me from loving her. Please, Gina, notice me. I've commented on her tweets a few times, nothing weird. She's never replied, never liked any of my comments. It's okay, fam. One FOMC at a time. I should type up a very formal letter and send it to her or whatever her agency is. And be like, we humbly request you join us. How dope would that be? If she joined us for a live stream. especially in FOMC. It'd be well, she can in FOMC. She'll be there in person, but even just like a little video cameo would be dope. Sure, Powell is warming up in the locker room. That is correct. What's up, Asherif? How you doing, brother? You're going to buy 1 Bitcoin for your wife and goat. You're going to have a rich goat someday. Pow, Gina. What's up, Shrink Tech? 420 Bud Monster. We already hit 420 likes, guys. Don't need. Well, no. Let's get 690. She will send a restraining order. No. No. I've never been weird. We've always kept it very respectful and classy here. Other than whining for her love, we've kept it classy. Ooh, can we start a culture where you need to 1 Bitcoin? Well, I think as a millennial, everyone here can agree, F diamonds, that's a scam. I think Bitcoin would be a much better thing to propose with. I just don't know the success rate of such concepts. You'd have to find a very special gal. An extremely special gal. Ew. Ew. By the way, guys, I do want to say I didn't want to like get into really these topics or anything, but I do feel I need to bring this up. So over the last, let's see, open this in private window. Over the last week, there's been an incredible amount of SIM swaps, and while I'm burning time here, might as well just do a PSA for the community. There's been a crazy amount of SIM swap attacks over the last week. Lots of creators, including Ben Armstrong, I believe Kevin Svensson, there's likely more I can't name off the top of my head, have been going down. This is a very advanced social engineering / SIM swap attack, and I need you guys to know I will never post suspicious links on my socials. In fact, in general, if I spam any links other than our sponsors, be suspicious. Check your links before you click anything. I would just recommend not clicking links for a while. Don't connect your wallets. I have taken every precaution that is possible. I'm not going to name them because I don't want potentially the attackers to know what I did. The element of surprise will be on our side. But know that I've done everything. I've gone above and beyond to protect my accounts. And I hope that this keeps us safe. But there's no guarantee. Security in crypto comes down to your end. It comes down to self-custody. And so the onus will be on you. But I'm warning you guys. Be on your toes. Be alert. Be on the lookout for scams. As always. What's up, Andy Bitcoin Census? What's up, brother? Coming in to tell us you're going live. Good for you. I would have shouted you out, but not now. Not now, Andy. No, I'm just playing, man. What's up, Cole Kurids? Jorganapers. I can't pronounce that one. Gomez. Subscribing. Good to have you, fam. Keep subscribing. Keep smashing the likes. Keep sharing. Hyping up the Chirp House stream. What's up, Ditzy Structive? It's only an advanced scam if you fall for it. Yeah, well, there is all levels of people here in our community worldwide. All levels. And so we want to protect them. If I can offer you guys anything at the end of the day, I hope it is just a little education and protection against loss. I'd be very happy if that's all you get from me. BTC dump or pump today, asks Vishal. The answer is yes. The answer is yes. Pulse Chain looks like a scambo. Says Digital Orgy. No comment. It was your birthday the other day. Shout out Crypto Surge. Happy birthday, my friend. How's that? I don't know what that means, Grim, but welcome. Good to be here. Good to have you here. Could go sideways. Likely it will go up, down, and sideways. No one falls for a scam until they do. Wisely put, Accession. Wisely put. The answer is yes. Watch it only crab now. It's possible. I doubt it. We out of the, how many of these have we done? If there's one a month or maybe 10 a year, we've been doing them for 2+ years. Out of the 20+ FOMCs we've seen, I think 1 or 2 have been truly sideways. Even before these were an event, we saw high volatility on them. It's always possible, though. It's always possible. You got to stay on your toes. That's why I recommend at the start of these, every time at the start of these, not to trade these. If you want to trade them, if you're not going to listen to me, that's fine. I don't expect you to. But, I I mean, I'm not going to say I told you so, but just be careful. We've seen longs and shorts get wrecked very consistently on these meetings. We see whipsawing price action, where we see our highs broken, our lows broken, and then maybe it does then return to sideways, right? Leaving longs and shorts wrecked out. I want to comment as well, we have seen very large amounts of Bitcoin, Ethereum leave exchanges over the last month. However, in contrast, we've seen large amounts of stablecoins also leave exchanges over the last months. So here's the thing. That is reducing sell pressure and buy pressure, meaning we may see even more volatile moves today. As there's less sell and less buy, that means the market is more prone to swings, to volatility, and essentially to getting wrecked. Be careful. Be very careful. Optical Art put a chart in Discord for you. Steve, did you send it to me? I'll pull it up. You did, my man. Load this in the stream. Loading, my friend. Oh, the rings of power. The ring. Optical Art. Peak of Bull Run. So, Steve, what happens if we go to this ring and we move up? What happens then? Kind of reminds me of like an EDM festival. Trading sideways, descending high trend, looking for the ring. I assume Steve is looking for a break of the ring and then a fall. Ooh, FOMC, so maybe even suggesting 23.7 on the FOMC. I don't know, maybe I'm misreading that. Perhaps. Steve, care to comment? Let me pull it up. What is that? A BDSM thing? I don't know even what you're referring to, techno goody, but maybe. Okay, that can happen. Look left, zoom out. Looking left, zooming out. More left or no? Your wife's in my DMs. Red ring crash. Okay. Did we have this red ring crash before? You back here? Red ring crash. Ah, I hear red ring crash. Okay. Any more notes? Zoom out more. Zoomed out. If BTC goes up, then time goes backwards. Well played, Alfresco. Zero liquidation. Red, fib circles only. I'm colorblind and this is, I'm having trouble seeing the red. See red, red, red. The problem for me is there's so many colors here, my vision gets weird. I can't tell if things are red or not. I'm not even joking. Steve, thank you though. Steve is looking for a move to the downside, which is interesting as I also talked and discussed. That's the side I'm leaning on right now. I don't know if it's going to be as low as Steve's numbers, but I'm also looking for a move to the downside as we're under the 200 weekly. By the way, we have 2,500 people here. 2,500. Well done, fam, showing up in numbers. We have only 8 minutes until the interest rate decision is in. We have 665 likes. We need to get 1,000 likes. First, we need to get 690 because 69 nice. But we need to get 1,000. We have 2,500 people here. Let's get 1,000, fam. Right now, pick up your finger, your mouse, hover on over to that thumbs up button, click it. If later in the show you decide you don't like the show, you can change that to a thumbs down, no worries. But let's get the engagement going. Let's get the votes in the polls, subscribe, etc. We have less than 8 minutes until this interest rate decision comes out. It's going to hit the market hot. What's up, Goncalo, Zebra, Andre Oliveira, RC, Ahmed Eli Welly. What up? Welcome to the fam. Welcome to the fam. Let's go. I got Forex Factory pulled up. They won't have the numbers yet. Ooh, but it has a countdown. Maybe this is the site that I was looking for. Maybe these are the droids I was looking for. Ooh. Shout out to Forex Factory. Their UI sucks, but the site itself actually seems very good. Seems very solid. let's do while we have a minute. Let's shout out. I like doing this. I swear it's not petty. It's just funny to me. Let's shout out all the other people hopping on the FOMC train. Remember, we are the OGs here. We originated the FOMC meeting. We did it before. It was cool. In fact, I'll go as far to say as we made it cool. But let's shout out Evan Aldo, Tony Vase, Frankie Candles, Blockchain Basement. I guess they're not actually covering it. Maybe they are. Let's see who else is going. Let's see FOMC live. Let's shout out these Crown fans, let's call it. Stock market live. I mean, they're always live, but shout out to them. Let's see who else. Just remember, nobody cared about these. Beginner trading is live. The Traveling Trader. Trader's Reality. Bloomsburg, whatever. Trader Nick. And everyone else who's covering it. Shout out to them, fam. Happy you've chosen. I know you have a choice in your FOMC streams. And we're happy you've decided to make that choice with us. Sounds like an airline. 5 minutes, 26 seconds to go. It's getting spicy. Let's take a look. Dollar still trending up. Bitcoin. Okay, here we go. This is odd. Bitcoin was trending down. I'm not going to make any conclusions yet. I'm going to hold that for the rate decision. The dollar in a pretty clear uptrend over the last hour. Bitcoin traded down, returned to, I'll say where it started, equilibrium. Now up a little bit going in. I'm not going to quite say that this is trending up yet, as it's really just kind of too close. But we do see a divergence from the S&P. The S&P has traded down and now is sideways into this interest rate decision. So this is still looking to trend down, at least in my opinion at the moment, while the dollar is up and Bitcoin is sideways, I'll call it. So we're not seeing our typical Bitcoin stock going against the dollar into these decisions as we've seen over many of them. It seems that we have, I'll say dollar up, Bitcoin sideways, stocks down. We have everything. Someone said, is it going to pump or dump? Yes, it is. All of the above. What's up, Tautividus Stevas? Probably said that wrong. Thanks for subscribing, my friend. Good to have you. Oops, didn't mean to hit that button. 2,700 viewers as we close in on the live publishing of the interest rate decision. We have our site pulled up. My alert's going off to remind me we have 3 minutes, 50 seconds to go. The market has been favoring a no BPS interest rate hike. Let's see if those numbers changed. It was pretty volatile when we started up earlier. It had changed even when I just refreshed it. Let's pull this up. 97.8. That's up from like 9. Oh no, they're down for maintenance. That's not good. No. It refreshed even in the beginning. This number changed. It was up. It was at like 98, then it went down to 96, now at 97. Needless to say, the market is overwhelmingly confident in a no hike today. Getting a hike today will be the most volatile outcome, probably to the downside, at least short term, if we do get a hike. With the market so confident, that will create a lot of uncertainty, especially looking forward. And the even equally less likely chance that we have a negative interest rate hike. I didn't even put that on the poll because I think that's so unlikely. But if we did, that is probably will equally lead to volatility, but likely more to the upside, as the markets clearly have priced in or have begun pricing in zero interest rate hike. 3 minutes to go. Guys, get your Google tabs out. Forex Factory hopefully will update us right away in real time. We'll find out. But what I need you to do is go ahead, open a window on Google. Doesn't have to be Google. Actually, let's use all of our search powers. Type in some variation of Fed interest rate hike. Why did this... Brave, I did not ask you to do that. I'm going to go to Google. You don't have to use Google. I like to use Google during this because I can go to the tool results past hour. So anything that was published before 2 p.m., so any articles right now that are published do not have the numbers. They will have the numbers at 2 p.m.
The suspense is killing me. Thanks for the stream at Tom Crown.
Mr. Casper, our homestead Hercules, swooping in with the super chat. Bro, I've missed you. I know our viewers have missed you. I know your viewers are probably missing you a little bit. Jason's hands are full with the homestead, taking care, grinding it out. You guys definitely subscribe to Jason Casper. Links in the chat. This is a good dude. He's a good dude. But get your tabs ready. The suspense is killing me too. Keep the hype going. Keep the energy up. Much love to Jason. Love that guy. 10 out of 10. 5-star man. Get your tabs ready. We have 1 minute, 30 seconds to go. Only articles published after 2 p.m. East will have the numbers. So we're going to crowdsource it. If you find it, it has to be published after 2. If you find it, put it in chat. Include a source. Please don't just put no hike or 25 or whatever. Please put a source. Without a source, we won't really know at all if you have any idea what you're talking about. 50 seconds to go. LFG. Suspense is building. The hype is building. Ooh, there we go. Shout out to Axel Boy for making that so long ago. Where are you, Axel Boy? 10 seconds. 10 seconds. 9 seconds. 8, 7, 6, 5, 4, 3, 2, 1. Google. Google away. Go. Go forth and find the answer. Pending. 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 I like this, though. It updated right at 2 p.m. It knew right at 2 p.m. Do we have an answer, chat? Has anyone found it? Infinite rate hike, says 10 pence. Infinite rate hike. I like that. 525, according to TradingView, no hike, paused, 0 BPS. I'm not seeing sources too much. No hike on TradingView. Did TradingView beat everyone to the punch? TradingView, no hike? No hike is in. No hike is in. 0 BPS. Let's tweet about it. Boom. Holy shit. The dollar blasting off here. I was going to tweet about it, but it does not seem like there's time. Stocks plummeting. Not really. Down 0.16. But the dollar blasting off here. 0.2% in a 1 minute, not even 1 minute candle. That is wild for the dollar. Really showing strength here. Kind of against the intuition you would have of a 0 BPS hike. It is still climbing. Stocks are still dumping. Bitcoin roughly where it was. Wow. Wow, 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 wow. Wow, 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 wow. Dollar really moving up. Stocks really moving down. Chat, what is going on? Holy shit, what is going on? There has to be some other news. There has to be something else. There has to be something else with this. Did any other news just break? Move chart back. Move chart. No. Did any news just break? What the fudge? What the fudge? Holy moly. I told you guys, these are wild. These are absolutely bonkers. Bitcoin really not doing much moving off of this. The dollar moving in a way I don't think I've ever seen it move. Really blasting off. Holy shit. Holy shit. Stocks hit a low. Does not really look like they're rebounding quite yet. Let's pull up the S&P 500. Let's see our daily. On the day, that move looks a lot smaller. Mind you, we are zoomed into like the 5-minute time frame. Don't freak out. This is why I say I don't recommend taking trades today. But stocks definitely pulling back here on this dollar strength. Down 0.2% for the day. However, down 0.7 from their high of today. That's actually pretty big. It's pretty big for a 5-minute candle. Holy hell. Holy hell. Take a look at the dollar on the day here. Dollar still down 0.26, so I'm not super convinced by this rally yet. The day opened at 103.3. Trading above 103.3, looking a little bit better, but you still have a lot of ground to make up. Maybe 103.6 before this is actually looking like a significant reversal. I think I can pretty confidently say this. Looking up here, 103.1, which is very, very close, mind you. Very, very close. Let's get rid of these. Very, very close. 103.17. That was where this looks like today's candle fell from. Retaking 103.17 is going to be the first step to a larger retracement, a larger move to the upside. Below it, this is a crazy effing candle. Get hype, smash the likes. This is a wild FOMC. Wild FOMC. I can't wait for Powell to speak. But below 103.177, not a lot has changed for this day on the dollar, but it is spicy AF. Holy shit. Holy shizzle. Wow. Just wow. Right on. It's only been 3 minutes. It feels like it's been an hour already. It's been 3 effing minutes. And there's so much happening. Stocks are still dumping. Holy crap. Let's get rid of these on higher time frames. Stocks still taking a dive here. Oh my goodness. Cleaning up the chart. The downside still isn't super significant on the S&P yet. The dollar does look, is it getting a little bashful near 103.17? Maybe. I don't know. I wouldn't bet against it quite yet. That is a hell of a candle. We haven't had a candle like this on an FOMC stream in a while. Let's check back in with Bitcoin, though. It seems to be the least affected by whatever the hell's going on. Whatever's happening. Down 0.5% for the hour. Not huge. Definitely in stark contrast to the dollar and S&P's crazy moves going on. Really still in, not really invalidating anything. Lows still kind of coming up. That could change. I mean, that could change any minute. Sure, Powell could come on and that could be wild. And yeah, when you zoom out, this move is just not quite what it felt like. We haven't seen that much volatility in a while. On the day, Bitcoin still relatively right in the range of yesterday and the day before and the day before. Well, freaking dollar rips, man. Rips. It has not gotten back to 103.17 yet, but it's kind of looking likely, isn't it? Oh, adjustment share. Ugh. Here we go. There we go. I don't even know. Chat, is there more news? Is there more news? Let's see. Somebody super chatted. Craigton, Fed pause, but hawkish. Forecast 2 more hikes this year. So, who won the poll? Who won the poll? The Fed does kind of stick to their word when they say this kind of stuff. When they say we will have more hikes. 37% of us, including Tom Powell, agreed no hike, but more hikes in 23. That looks like the winner. 2,000 votes. I mean, you could vote now if you want, but it's kind of already out there. Let's end that poll. How on earth is this a bull market? Doesn't really seem like one, does it? Dixie crossing. Boom. It has retaken this first level we're looking at. Still red for the day. Let's throw this on here. But it has hit a retracement, likely to retrace some more here. 103.3 is the daily open. Let's mark this on our chart. The dollar heading for a green day. Boom, boom, boom. Let's turn up the tunes. Keep subscribing, keep liking. Join the Discord. Sign up with the links in the video description below. We have 3,200 viewers on what is now the spiciest FOMC, or should I say pre-FOMC, we have seen in quite some time. Quite some time. Bitcoin not really in on the fun, it seems. I want to get rid of... Okay. Give me just 1 second. Here we go. Boom. The dollar ripping up immediately on the second, basically, of this interest rate decision. No hike today, but 2 hikes planned. Does seem Bitcoin now is finally following stocks down 25.8K. Holy moly. Holy moly. That's really not a huge move yet either. But with what the dollar and stocks are doing, would not surprise me to see further downside potentially here. It seems like stocks are leading the way down. Let me check to see if this is still good. Good. Boom, we are on the 1 minute. God, I don't want this. Okay, good. There we go. Let's put it on the 1 minute. So remember, everything here is going to be very exaggerated because it is the 1 minute chart. But these moves, it is moving. Holy crap. Let's zoom it in. Right there was the decision. 1300. Tom Powell spoke. All right, here we go. All lined up. The dollar ripping, heading towards that green daily. Holy hell. The spice is back, boys and girls. It's back. It's back, baby. Right. Top. Green daily above 103.3. Dollars reaching up to it. Oh, it's hype. Let's see. S&P 500. Let's mark red daily. Keep smashing the likes and subscribes, guys. Keep the engagement going. Chairman Powell will be joining us shortly. And the chaos. Bearish and golf a bit low. The chaos is palpable here today. Palpable here today. S&P did trade down to a bearish engulf on the daily. It has bounced, at least temporarily, from there at the moment. 4,347. The dollar reaching up to a green daily, but hasn't quite gotten there yet. Take a peek at Bitcoin. Bitcoin's so tight that it's just so tight. Let's mark our range low. Let's mark bearish engulf. We'll mark green day. We need one more. One more. No. Looks like Bitcoin now down, also bearish engulfed. Has not gone all the way to 25.3. That would be the kind of range low, wick lows there. But definitely selling off on, I guess, markets pricing in 2 more interest rate hikes this year, maybe. That would be my only logical thing. The dollar has not flipped to a green day despite one of the biggest, fastest, most volatile upside moves I've seen on the dollar. Maybe ever. Maybe ever. Stocks rejecting the bearish engulf, at least temporarily. So, to rewind, we talked at the beginning of the stream how we usually see this go. We usually see markets trending in one direction into the rate decision, a strong reversal, and then another reversal when Jerome Powell or Chairman Powell speaks live. So the only silver lining I can say today is, well, stocks down, Bitcoin down, and we see in 20 minutes, not even, Chairman Powell will join us. Hopefully we get a reversal again and we see more upside price action. Although now the dollar's showing a little weakness. What do you guys think? I don't even have any more narration. I just want, what are you guys thinking? What are you thinking? This is wild. It's been a while since we've gotten a good one. Craigton C thinks that it's a bluff. There's a lot of bluffing going on, it seems, in the U.S. Kind of monetary agencies. The Fed coming down more than expected. But you think that the future rate hikes are a bluff. I don't know if they're in the business of bluffing. They might be. They definitely bluffed about inflation to begin with, saying it was transitory. No, they said there wasn't inflation, when they fully knew there was. And then they said it was transitory. And then now we've spent a year and a half battling inflation. So take it with a grain of salt. Jason Casper in the house. Yes, he was. I don't know if he's still here. Probably out farming. He's probably enjoying this rain. I know, I was messaging him earlier and I was like, bro, it hasn't rained in like a month, 2 months. My crops. The pickle. Peak gold quick. Anything for Sir Pickle. Yeah, gold is a good one. You know what? In fact, F that. Let's go back to the quad. Let's put gold up in the top. Or bottom? Put gold down here instead of the VIX. We don't need the VIX. CDF's on gold. We got gold in the bottom right. Let's hide this. It's 2:30 p.m., so less than 20 minutes, about 15 minutes away. Let's have gold up here. That's kind of spicy too. That's a little spicy too. Let's mark out just the same things we have on everything else. Gold looking a lot like Bitcoin. Not gonna lie. Kind of just in a range after falling. Wow. Gold has traded both bearish engulfed and bullish engulfed today. Just today. Bearish engulf below 19, or not bearish engulf, red candle. Whatever. It's all the same. Let's make these marks. Mark. Damn. Every market just popped off on that. Wow. Just every market. Look at this move on gold, down 0.34% in 1 minute, while the dollar moved 0.26 in 1 minute. I'm just trying to drink this all in. I'm a little jittery. I'm a little hyped on this. A little bit hyped. A wee hyped. There we go. We got Bitcoin at top left, dollar top right, gold bottom right, and stocks kind of nestled behind me. I don't know if I can... There we go. I can see it a little better. There we are. Let's add. Bull engulfed daily above. There we go. All right, that's all I'm going to do for here right now. Are you guys hyped? Let's effing go. What a day. What a day. Some of these have been not so interesting. This alone is super spicy. I can't wait to hear Chairman Powell speak. What's up, Sylv? What's up, Gregzilla? When move? When Lambo? What's up, Flat Smack? Join Crypto UK. Filippo Ericaso. When Lambo? Lambo was the friends we made along the way. In our heart. The moon was in our heart all along. Jim Kennedy looking droopy. Yes, it is. They're liquidating longs and shorts. Your shorts and your shirts. Why? If shorts are betting down, why aren't shirts betting up? Little trading comedy for you guys. There's artificial rain from hoses. I'm on a well, bro. If I use my hose, I'm just using the same water that comes down from the sky. Read the projections PDF. They say 5.6 in 2023. Christoph, where would I find that? Where would I find that? Dad jokes. I'm not a dad, but I can joke. Where did my Forex factory go? That probably has it. I think I closed it. Oh, my butt. Sitting on my butt. Economic projections. Here we go. Wow, alright. Shout out to Forex Factory. This is legit AF. Please update your user interface, please. That's the only thing you have against you, and it's going to turn a lot of people off. Summary of economic projections. In conjunction with the Federal Open Market Committee, held on June 13-14th, meeting participants submitted their projections of the most likely outcomes for real gross domestic product, 23 to 25 and over the longer run. Each participant's projections were based on information available, blah, 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 including a path for federal funds rate, longer value, whatever. Zero Hedge weighing in, saying that the 5.1 to 5.6 was the shock. Fed signals 2 more rate hikes. May dots, June dots, Dippin' dots. The Fed skipped but isn't pausing. The dot plot shows a median rate forecast rising to 5.6, so they expect 2 more hikes. Fair enough. I think this is going to be too much, and they're going to go over this anyway. Too much for me to interpret live. Change in real GDP March projection, median. Unemployment rate. They see unemployment rate rising to 25. PCE inflation falling. 2 in the longer run, 2.1 by 25. Core PCE, 2.2 by 25. Yeah, I'm not going to interpret all this live. They're going to literally go over this. They would show us this. They would show us these things. Change in real GDP down. Unemployment rate down. PC inflation up. Core inflation up. And the dots. I'm not going to lie to you guys. I do not pay enough. I guess these are votes. Maybe like each participant's vote on what they think is going to happen or where it will be. Yes, FOMC participants' assessment of appropriate monetary policy. Midpoint of target range level for federal funds rate. Yep. We'll have Chairman speak on it. He knows this stuff better than me. We have about 10 minutes, fam. Now is the perfect time. Leave the stream open. Go grab your brews. Roll one up if you're gonna roll. We got 420 likes today. Keep smashing the likes, sharing the stream. Subscribe if you haven't. Keep engaging. Chairman Powell will be live momentarily. Don't go anywhere. Stay tuned. Have we not? I don't think we've had a new subscriber in 20 minutes, which is odd. If you've subscribed and it didn't announce it, let me know. I'll shout you out. Let me know in chat. The will and me to stand. What is love, baby? Don't hurt me. Don't hurt me. No more. You've seen this before. The Fed is keeping its finger on the scale, injecting fear into the markets, but the hikes are just optionality. They felt confident to pause. I will agree. It is weird that they will pause today, but then continue hikes. Perhaps a reflection of that they have increased hikes. They have increased the terminal rate or whatever interest rate too quickly over too short a time frame. That could be kind of an admission of that. Though I don't know. That doesn't really seem like their MO. It is odd that they would pause and then do more. Because what is this pause really going to accomplish? They raised them last month when I think it was really needed to take a pause. They're always lagging. That's the problem with the Fed. They're always lagging. They're always behind. They always say, we'll have to check the data. But the data they're using is extremely lagging and not really, in my opinion, representative of many of the measures they're looking for. Unemployment rate is a terrible metric. It is a gibberish metric, especially in what is now a gig economy. It makes no sense. And their inflation, formula is just not in touch with 2023. Jenny Yellen inflated herself. She played herself. They lag and the market is forward looking. Absolutely. So they're playing whisper down the lane. Pausing for election season. Well, clearly not, Elonix Rodriguez. I would expect that. But if they're saying we're going to do more hikes, they're not playing the election cycle game. They would pause it into the election cycle if that was the case. Chairman Powell many times has shown me that he really isn't a partisan actor, and I believe that to be true. Hike will be on the table, meaning the weight of the next month's data will be enormous. That's a good insight, Randy Greer. That is a good insight. New subscriber, what's up, Joe Man? Subscribing, good to have you. Philip White, here we go. They all just came in all at once. That's annoying. Carl Cummings, giggity. Danny Hodgkinson, RC, Captain Skippy, Steve Waterworth, and Philip White subscribed. I guess it was lagging behind just like the Fed's data. Good to have you guys. Welcome to our fam. Welcome. Greetings from Bedford. Shout out to Bedford. Welcome, new humans. Subscribe, Yoler Coaster. What's up, Yoler Coaster? Martin Anderson already schmoking. Already blazing over there. Right on, brother. Right on. You just subbed, Philip White. We got it. You subbed and didn't announce me. I changed my name. Maybe it's because you changed your name. Light 'em up, Christopher Buchanan. Light 'em up. You're rolling. You see me rolling. What's up, Raphael? We have less than 10 minutes. This is not a drill. Less than 10 minutes till Chairman Powell is live. Friend Cios Gunther is live from South Africa. Shout out to South Africa and all of our Johannesburg viewers. I see you out there. I see you. We see you. Welcome. Biggest ever in what way? It's a good question. Escape the Matrix. Was gonna sub, but then you got high. But then I got high. And then I got high. That's okay, Mike W. But did I just date myself? Probably. Ordinal pumping. What is ordinal? All ordinals? What's up, bro tip? Liars. Hi from Dubai. Shout out to Dubai and all our EAU fans. Shout out to our whole global community. You all are appreciated today. We know you have a choice in your FOMC streams, and I'm glad you made the right one. The home of the FOMC right here with all of our fam. Hopefully Gina will be joining us shortly. I'm having my people call her people. No promises. BTC relatively holding, hasn't dropped out of its range. The dollar with an explosive move off of the Fed update explosive. However, still trading negative for the day. Maybe seeing a higher low here. Maybe reaching up to that green daily at 103.3. Gold seen a very volatile day as well. It did trade bullish engulfing before falling down to a red candle. Now trading at a doji green. And the S&P 500 chilling at its bearish engulf daily level, slightly above 43.47. The line in the sand. The line in the sand. Gold seems pretty stagnant now. Maybe back. Chairman Powell joining us shortly, guys. Grab your brews, roll up. The spice might not be over. The spice maybe has just begun. We typically, or in the past, have seen reversals. I don't know. We have seen reversals into Chairman Powell speak. I don't know why, but we've seen them commonly. Here comes Bitcoin. Everything just stopped, literally. Everything is waiting for Chairman Powell. Everything. About 5 minutes to go. The spice is palpable. Tom Powell joined us at the beginning of the stream with an eloquently stated speech full of metaphor. You unsubscribed, alright. Goodbye then, I guess. We'll be here. Brendan, the robots hang on every word they do. People are delusional if they think altcoin season is coming. It does appear that way right now, doesn't it? If Bitcoin dominance does reverse, if we do see it fall back into the range, I think then you can even approach that. You can approach that idea. At the moment, altcoin season does look canceled. Of course, that can reverse at any time, but dominance is likely to give you a heads up. Likely. S&P 500 now trading into a bearish engulf on the daily. But maybe it's a nothing burger. Maybe it's about to just bounce. Gold slightly moving up, remaining green for the day. The dollar does seem to be consolidating, accumulating, distributing, who knows, right below the green day mark. That's kind of spicy, actually. It's pretty spicy. That move up was wild. In like 1 minute, the dollar moved more than I've ever seen it move in 1 minute. However, it's still down for the day, down 0.1%. That is a strong bottom wick. If today closes there, that isn't bad. You can see some kind of daily support over here from May. That would be a decent close, showing buying pressure on that wick. However, it seems to be unable to flip green. Doesn't seem like there's enough buyers yet to flip green, but maybe that's about to eat my words. We will see. Chairman Powell speaking may change it. May change everything. Typically, we do see markets reverse when Chairman Powell speaks versus the interest rate hike. Will that happen today? I do not know. I do not know. But it could. Gina! Where's Gina? We got to get Gina in here. What? Was it a pause? Yes, it was. It was a pause with a commitment to 2 more rate hikes this year. So, not a real pivot. Dixie in God mode. Yeah, that was a God mode candle for Dixie. That's an interesting point, Craig. 200 points off the Dow is literally one stock, United Health. Markets are down a bit, and I'd agree here. Markets were pricing in 1 more hike. Maybe this possible extra hike is why. This could be why. 2 more hikes. Gina simps everywhere. We're the home of the Gina simp, my friend. We will simp for her all day, every day. Why 2 people came in and said the exact same thing? Gina simps everywhere. That has to be like a bot. Why would you bot that? If you're going to spend money to bot. Until Gina, we don't know. Let him speak. What's up, B4 Crypto? How you doing, bro? Coming to you live from Castle Fun Park. Just kidding. I don't know what that is, but it sounds fun. We've got 2 minutes. 2 minutes. Let's refresh. Ooh, they changed their tunes. I'm going to mute them for now. Mute it for now. I think the music they were using was copyrighted last time. Sneaky birch. Sneaky birches. Okay. Muted it. I'm going to turn our tunes off. 1 minute, 30-second warning. Whoa, Jack, subscribing. Get your subscribes in now. I'm going to turn off the alert box while he speaks, so get your subscribes in meow, so I can shout you out. Whoa, Jack, DM Skies, Horacio Ogtung, Pre-Direct are joining our fam. Good to have you. Good to have you. We've had, I don't know, at least 100 new subscribers here. Join us. Jump in, smash the like button, subscribe buttons. We have 60 seconds till Chairman Powell is live. This is not a drill. Grab your brews, roll up. LFG. Let's go. Let's go. Oh well. We'll just use the copyrighted music, I guess. Let's go. Equivoc. What's up? Welcome. Equivoc. That's their chillin' jams are too chillin' for this hype day. That would be cute. That would be cute. We'd have beautiful babies. Too bad she is very married. Oh, good call. I forgot. I have to move the chart. There we go. Good call. Five seconds. This is your last chance. Get the subscribes in. Here we go. Late as always, Chirpow. Late as always. 30 seconds late. Although maybe there's just a delay on the stream. Maybe that actually would make sense. Oh, my, what? Got a hydraulic desk I'm going to be installing very soon, so I'll be standing. Let's go. Let's go. Let's go. We've lost 1,000 viewers. That's okay. We push forward. There he is, the man himself.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yes, Gina. Gina, you're first. Please only Gina
Thank
speak.
you. Colby Smith with the Financial Times.
No, not you.
I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they've felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly. By historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
I expect the meeting to be live. Live meeting. Gina, please. Everyone shut
Thanks,
up.
Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, less of a hit to unemployment, slower progress on inflation. And I'm wondering, in this, sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Gina.
Nick Timmeros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward. And we'll get to see, we haven't really, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is, if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Everybody shut up. Shut up, Gina's talking.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where's sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively zero now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, with more data over time.
Rachel.
Gina again. Only Gina.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks
She
for
said
taking our
it,
questions.
Chair
I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the
Back
wire.
in my day,
So that's
newspapers.
different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
every hand in the room. Holy
Thanks.
shit.
Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or I mean, it's surprising to see so much hawkishness in the dots given what we're seeing recently.
Yeah, so, we've, remember, we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. So hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
No.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down. And that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet.
We'll need to look at the data.
So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. Are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecasts, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you.
Thanks.
So that's how they do that. Well,
I don't think anyone cares.
I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job.
Money.
We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Hard no.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
You know, I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%. And we'll do whatever it takes to get it down to 2% over time. That is our plan. And, you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to we're having real rates that are going to have to be meaningfully positive. And significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie.
Gina again.
The mic is coming.
Oh, sorry. Thank you. Hi, Chair Powell. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about. There are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, as a factual matter, that's correct. We do need to see, rents bottom out here or at least stay quite low in terms of their increases, because we want the, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important. And so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services, excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg. Thank you so much, Chair Powell. Greg Robb from MarketWatch.
Chair Powell.
I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very labor economics, and the labor market are utterly central. It's half of our mandate, so we spend a lot of time talking about that. I think, there are structural issues that are really not for the Fed, and so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk, now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
Absolutely.
So, we're trying to think where to start. I'll start with commercial real estate. Of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things in
boy, oh boy, he is walking around this question.
Conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last
I
part?
guess that's what I would say.
Do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
Thank you very much, Helga. Thank you very much. Wow. That was spicy. That was actually spicy. Last time, not so spicy. This time, hella spicy. To summarize, the Fed paused for this month, however, indicating that there's 2 additional hikes coming in 2023. Markets reacted in the spiciest of spicy that we've seen in a long time. The dollar blasted up, didn't actually trade into a green day, came just shy. It may have put in a higher low here and may look to trend by the end of the day to a green close. Stocks, the S&P 500, daily flipped to red after hitting a new 23 high. Let me see. Buyers seemingly came in at the bearish engulf on the daily, but unable to really pick up the momentum here. Bitcoin being the least impacted, seemingly, of all these assets we've covered today. Yes, we did see a daily low, but we're still well within our ranges, and really not a lot of change here, just some volatility stopping out longs and shorts attacking those leveraged positions. Attacking them. This was hella spicy, guys. If you didn't subscribe. Join us for racing Bitcoin to 100K. Jump in the Discord. Don't forget to sign up with our sponsors, Fairdesk and FEMX, 2 of the greatest exchanges out there. Use my link for some sweet bonuses, and that's about it, fam. Tom Powell joined us earlier, had some great insights. Go back and watch Tom Powell's intro speech. I highly recommend it. For today, that is all, fam. I'll catch you on Friday. Crown out.